I wanted to focus today on how to find the intrinsic value of a stock to see, compared to the current stock price, whether or not you're getting a fair price for a company that you wanted to purchase. Now, today we are going to focus on a fundamental analysis. There's many different ways to do these analyses, but this is more of a long-term value approach compared to a technical analysis, which may be used by a day trader or somebody that's trying to invest on a short-term basis. So this analysis is going to be used for somebody that wants to hold their stock for years and potentially have compounded growth over time. I wanted to start with a top-down approach in this video. So we're going to look at a macroeconomic structure. You want to look at GDP growth, projections for interest rates, whether they're going to be hikes or decreases. You also want to look at possible inflation, especially in these times. That's one of the big concerns that a lot of people do have. Different public policies that may come down. So if they're looking at a spending bill or an infrastructure bill in today's market, things that could alter how certain companies may change their projections on earnings growth. After you do that type of an analysis, then you can look at different companies in the sector and how does a company compare side by side, and you can check different projections on in the future what the earnings may look like for those companies in comparison to some of their competitors. After you do all that, then you can look at price to earnings ratios and try to compare the different companies. Now, these are just one other tool that you can use. It doesn't tell the full story of the stock, but it gives you an insight into whether they may or may not be cheap or expensive versus other companies that are in the same sector. So you can do a comparison from company to company, or you can do a comparison over the whole market compared to your company to see whether or not it may be under or overvalued. These generally are only good for stable market conditions. If it's a fluctuating market or there's a lot of change, as in recently, you have to be very cautious with using these values. There's different things that you can look at compared to earnings growth and earnings per share, or EPS. You can take like the last 5 to 10 years and see if you've seen an upward trend in a company or a downward trend, as well as different free cash flow values. You can kind of take the same approach. Have they been able to continue to grow their cash stream, or have they been losing cash over the past 5 to 10 years? And that will help some of these projections that we're going to do here in this analysis. When we want to look at a discounted cash flow model, this is going to probably be the most common approach to finding intrinsic value in a stock. So the idea behind a discounted cash flow model is that $1 today is worth more than $1 in the future. So we pick a percentage that we're able to discount that back, and we can check to see whether the price today, since our money is more valuable, is a fair value compared to the future price of the stock. There's many different ways to do this, but I don't have the time to sit down with a pencil and paper and write out all the math and the formulas. If you wanted to do that, you're more than welcome to do so, but there's plenty of different calculators that are out there. One of the best ones that I have found to do a DCF analysis is on Guru Focus, and I'm going to put a link down in the bottom of this video. And they have a really, really good website for value investors to go through all of the different numbers, but I found the calculator to be the most user-friendly compared to some of the other ones that are on the internet. Now, the most important thing to remember about this video are that these estimations are only as good as the inputs or guesses that you're putting into these calculators. So you can structure these in a way to confirm your own biases if you're not honest with yourself and your numbers. So please make sure whenever you're doing these estimates that you are putting in your most accurate predictions and you're not trying to confirm your own biases. Otherwise, your numbers could be drastically off. So I wanted to take a look at Alibaba today. And there's 3 different estimations that you have to make when valuing a company. So the first one is the discount rate. So today we are going to use a 10% discount rate. And the reason why I chose this, just for an example, is it's the average return for the S&P 500. So what that means is that the higher the percentage that we are using, the more that the value is going to be discounted going forward. So the price at the end, the value the fair value that we are going to use is going to be lower the higher the percentage number that we use. In more risky investments, if you might want to choose a higher discount rate, it's going to provide you a lower price at the end. Whereas if you feel it may be a safer investment, then somebody may choose to use a lower discount rate, and that's going to give them a higher price at the end. Just to understand how that kind of works. The second estimate that we have to make is the growth rate of a company in earnings per share. So if we take a look at Alibaba here, their earnings per share year over year has been negative 17.5%. If we look at their 5-year, it was 23% annualized. And then at 10 years, they've been growing at over 50% annualized per year over the past 10 years. So we have seen in the last year that there has been a decrease in earnings per share, but there have been a lot of different issues that have popped up. This market has been very, very fastly changing due to COVID and certain regulatory issues in China. That's one thing to keep in mind. But their earnings projections, if we look at current analyst estimates, are to be at approximately 15% long-term growth over the next 3 to 5 years. So the third and final thing that we have to estimate is the terminal stage of a company. So what that basically means is that once a company continues to grow over time, their earnings growth is going to peak and then start to slow down. Once it hits its peak, then we have to estimate into the future what a company's growth is going to look like towards the end of a more mature company. This tends to follow inflation or GDP growth. So we're going to just use 3% for Alibaba over the next 10 years as a conservative estimate. Inflation generally will run around 2 to 3%, and China has seen a ton of GDP growth in the past. But just to use a conservative estimate, we're going to stick at 3% here. And then after that 10-year terminal period, it goes to 0. So we're not going to try to estimate any more growth in the future beyond a 20-year period, because 20 years from now, a lot could be different. We don't want to try to guess what is going to or isn't going to happen in the future. Once we put all of those estimates into the calculator, we find that we have a fair value price of $196 per share. Now that estimate is compared to a current share price that's in the 150s. One thing that we can do with this is we can find a margin of safety. So what that basically means is we find the discount compared to what the current share price is and what the fair value price is for the company. And we find that the share price for Alibaba gives us approximately a 20% margin of safety with this estimate. So that gives us a buffer to show whether or not we may or may not be right with these prices and these projections. And that gives us a 20% chance to be wrong and still not lose money. Now let's take a quick look at a second scenario. So we'll take the same company and we will take its average 5 years earnings per share growth estimates, and we will plug that into the calculator instead of the 15% that the analyst had estimated. And we're going to use all of the same numbers outside of that. This gives us a fair share price of $315 per share, which is double what the company is listed for today. That is approximately a 50% margin of safety. So we have a 50% chance to be wrong with these projections. Now, companies generally, as they get bigger, they will slow down. It's hard to say what is going to happen with Alibaba. That is where the brilliance comes in with coming up with these numbers. But if that is the case for this company, then it is way undervalued. The third scenario we're going to use is if the company doesn't grow much. It really misses a lot of these projections, and we're going to use a growth rate of 5% per year. And all of the numbers are going to stay the same otherwise other than that. So in this scenario, it would give us a fair share price of $100 per share. So that would be a very bad investment going forward into the future. The purpose of these demonstrations is to show how manipulating the numbers can have a drastic change on the outcome. I try to use relatively conservative estimates, but you have to be honest with yourself instead of trying to plug in numbers that justify what you're thinking at the time. This is why Warren Buffett often says, I like to value the stock before I look at the stock price to prevent having any biases. And that's something that's very important to keep in mind. A few other metrics that you can look at are the total debt to cash on hand for a company. Now, this gives us an idea of the safety of a company during a correction, whether or not it would be able to meet its financial obligations, or whether it has too much debt and it may be at risk of a bankruptcy. If we take a look at BABA, we see that currently its market cap is around $428 billion. It has a total debt of around $28 billion. So this balance sheet is absolutely amazing. They could pay off all of their debt tomorrow and still have almost $50 billion left over. Now, before you run out and buy Alibaba right now, one thing I do want to caution people about, and this is the main reason why we're seeing such a discount in the price compared to what some of the earnings projections are in the future, is currently when you buy Alibaba, it's considered an ADR. If you don't know anything about VIEs or ADRs, I would consider doing a lot more research on this. Basically, what that means is that there is a company in a different country like the Cayman Islands that holds certain contracts for these shares that you are actually buying into instead of holding shares of the company yourself. Now, why this is so bad is that the Chinese regulators have known about this for many, many years, but they haven't done anything about it. They generally don't let their own population hold stocks in companies. A lot of their population is in real estate. But why that is of concern is because the Chinese regulators could wipe these VIE structures away, and then that would have a huge impact on the markets, and you would probably see a huge dive in the stock price. That has been the big concern, and there's a lot more information that I would recommend looking into before you would make one of these purchases. But this is just a general overview on how these structures work and how to do an intrinsic analysis on a certain company. Something else that you can look at are dividend payouts versus their payout ratio. So if you are invested in companies that offer dividends, then this might be something that's of interest to you if you're a dividend investor. So there's a few different other metrics that you can continue to look at. This is just a basic overview of one way to value a stock. But the most important thing to do is that you have to do your own research, and that these estimates are just tools that you can use in your own portfolios, and there's many, many different ways of coming up with them. If everybody in the stock market agreed on the same projections, then there wouldn't be any discount for companies, and there wouldn't be any opportunity for growth that's above the average, because everybody would buy the same things. So that's where these projections really may set you apart, whether you want to beat the market or you're going to lag the market, is depending on how good your research is, and depending on if you're emotional, whether or not you're able to handle some of the volatility. Again, please make sure you do your own research. I am not a financial advisor. I'm just here to help some people understand the different tools that are available and to help them make better decisions in the future on their own finances. And if you do like this video, please make sure that you hit the like button and subscribe to my channel. I'm going to continue to put these out every week, and hopefully I continue to help people with some of these investing techniques. Thank you.